Tom, nice to see you. It's been a while since you and I have spoken. Give me your take here as to why you don't think this is simply a bear market rally, because plenty of market participants, I'm sure that you speak to and that I do, are still looking for weakness yet to come.
Hi, David. Yeah, great to see you. I think there's been a cognitive negative bias to markets since the Fed began tightening and since inflation rose. And most of our institutional investor clients think that this is a template for a recession, and many think this is August 08. So we're only in the early stages of a deep downturn. And the reason we're more constructive on markets is, one, over the past 9 months, I think investors became convinced that inflation is with us for years, and it's very sticky. But it looks like inflation is proving to be a lot less sticky and maybe even more sensitive to gasoline falling because of how gasoline moves through the services CPI. And if that's correct, then we are tracking more towards a soft landing that's more like 2018. And that would mean markets have already discounted much of the Fed tightening. And so we would want to be buying this rally. And then I think in the past 2 weeks, the market internals, whether you look at the percentage of stocks above the 50-day or market retracements, or even moving back towards the 200-day, are actually kind of confirming that this looks more like the start of a new bull market rather than a bear market rally that leads to new lows.
Let's go to the bond market. So I know you've also been talking about that in terms of where the 10-year is right now and what the implied PE therefore is, and whether you can anchor some sort of a PE for the S&P based on that. Are you getting confident that, in fact, PEs could be going higher as a result of sort of, let's call it, we're in the right range for the 10-year?
David, that's definitely coming back to us, because when clients talk about the fear that inflation's sticky, we point to the 10-year at 2.8. That's hardly where it was in the 80s. The 10-year should properly reflect inflation expectations, and at 2.8, it's really a market that thinks inflation gets back towards something like 2% after a couple years. And then we know people talk about the inverted yield curve between the 10-year and 2-year. But what they have to keep in mind is that if inflation in the next 2 years is at 4, the 2-year yield has to be higher than the 10-year. So you're going to get a forced inversion just because of the contours of inflation. And it doesn't mean that the curve on a real basis inverted. So, yes, I think the bond market's telling us a better story than the equity investors want to believe.
Tom, I want to press you a little bit on your view of Fed policy. You see it as becoming more dovish, but what leads you to believe so? I mean, we got minutes yesterday, and it was easy to see sort of the hawkish side of them. More restrictive rates is required. Commodity price decline, even though you've talked about it, they say that it's not enough. And they said that there's a danger that inflation becomes entrenched. Is this market not simply fighting the Fed, which conventional wisdom tells us is a very bad idea?
Well, I think that the word dovish and hawkish are used by too many investors and by most of our clients as like a binary fact. The Fed needs to raise rates. They're at the neutral rate now. But let's say that they get to 3.5, even 3.75 or 4, which is further tightening. That may not be a shock to equity markets. And you can look at many periods when the Fed's been raising rates. In that second half of a rate cycle, equities start to rally. That even happened in August 82 when the Fed hadn't given up the inflation fight, was still trying to shock markets. But the stock market bottomed 10 weeks before the Fed even posited shifting. So I think that this is not necessarily about a Fed pivot. It's about the fact that the Fed isn't trying to shock markets and deliver essentially a nuclear financial tightening. That's what they were trying to accomplish early this year. That's not the case anymore.